into the rodeo because that's the time of year we're in right now. We literally just had probably the most insane week of the year so far, and I think it's just getting started. The insanity is only just beginning, so buckle up, kid. But first thing I'll point out is, look at Bitcoin. It's just holding the trend line, right? Now, I'm going to get into these other charts in a second, and you're going to see why it's pretty significant that Bitcoin is just holding this trend line. It hasn't collapsed. Nothing has fundamentally changed the structure of the chart at this point. But look at some of these other charts this week. I'm looking at weekly candles. This is Silicon Valley Bank right here. Look at this weekly freaking candle on Silicon Valley Bank, kid, okay? This is like bank runs. This is like panics. This is like Lehman Brothers. This is like 1929. This is like this kind of stuff, right? So from looking at a chart like this, you would think that markets would be seriously under pressure right now. And in the financial sector, they are at this moment. But let's look around. Let's look at the SPY. It did break below the trend line. Yes, it did. And this could be the start of major selling. This could be the start of breaking this low, which I said would be game changing. And I stand by that. If the SPY breaks below here, the December lows, well, then you no longer have an uptrend. It's very, very simple. But what I'm trying to point out here is that the pressure hasn't really gotten too overwhelming on SPY. Look at the Dow Jones. Dow Jones is still above this trend line here. So at this point, it's possible that the Dow Jones is only going to come to test this trend line. And until Dow Jones breaks through this trend line, as far as I'm concerned, it's still in a bullish configuration. And I would argue the same thing is true on the SPY. This is still a bullish configuration because I'm going to argue that the uptrend, meaning higher lows, higher highs, that supersedes the fall through this trend line. And the more time spent below the trend line, the more significant it is. At this point, we only have really 2 days spent below this trend line because this market started collapsing on Thursday. Look, actually, it was only Friday that got below the trend line. So at this point, I don't think it's like, okay, here we go, bear market nightmares. It does sound pretty bad, but here's what I want to point out here. I want to talk about what's going on politically at this time because there was a very important event that happened this week on Tuesday. So if this is Friday's candle, Thursday's candle, Wednesday's candle, this is Tuesday's candle. Jerome Powell testified before Congress. Now, he said the same things he always does. He says, we're committed to raising rates because that's how we're going to fight inflation. Like he's basically saying we're going to raise rates no matter what. There's nothing that's going to stop us from raising rates. But what's really interesting is that both political parties agree on something. And what they agree on is that Federal Reserve needs to lower rates. Republicans and Democrats both want the Federal Reserve to lower rates. This is the gist of Tuesday's meeting. Tuesday, right? And then what starts to happen on Thursday and then on Friday? Big, scary nightmare things. So what I'm saying is there's already a lot of political pressure for Jerome Powell to lower rates. That's because both political parties agree that we can't keep the Spending America show going if interest rates continue to rise. And both political parties agree that they want the spending to continue. That's what's going to make the economy work. And to be fair, they're right to some extent. Now, the politicians have a good argument, but also Powell has a good argument. So let's just talk about Powell's argument. Why doesn't Powell want to lower rates? Why is he so committed to the job? Well, we're going to refer back to my favorite chart that I always refer back to, and it's the old Fed funds against the stock market. So here's the thing. What are Fed funds? So Fed funds are essentially the rate that the United States government is paying people to lend money to it, right? It's the bond market, essentially. So if we're just thinking of the entire bond market as a whole, you have to realize that the United States has to offer an interest rate that is better than inflation in order for the bond market to survive. Nobody is going to be interested in the bond market if the bond market doesn't offer a rate of return that is better than inflation. Do you understand, right? So what does the United States government need the bond market for? The bond market is the mechanism by which individuals and corporations loan the United States money. So the United States needs to have the bond market be competitive with interest rates so that people are loaning the government money. And obviously, the government needs that money. They want that money. So it's clear that Jerome Powell needs to keep raising interest rates until they're above inflation, and they're not above inflation at this point, right? So he's got theoretically a long way to go. But the politicians are like, we don't really care if the United States is incentivizing people to lend money to it because all we want to do is drive spending. They're advocating for, the people, theoretically, in this case. And not to say, I'm not trying to advocate that politicians actually care about individuals, but in this case, they care about individual spending power. And the spending power of individuals is limited when interest rates are higher, right? That makes it harder to get money to buy things. That's harder to kind of fuel the economy. But the reason why this chart is so important is because there's actually a bigger thing at play, which is that there's a potential collapse of the bond market if the bond market stays below the rate of inflation for too long. This is exactly why Powell needs to continue to raise rates. It's not just about fighting inflation. It's about incentivizing people to lend money to the United States government. The only way the government can incentivize people to lend to it is if the government can offer a rate of return that is better than inflation. Right now, the rate of return that the government is offering is not better than inflation, and that means that the Federal Reserve needs to raise rates. If they don't raise rates, we have one of these situations where the bond market collapses. It's a basic supply and demand situation. If the bond market doesn't offer a rate of return better than inflation, then there's no demand for bonds and the bond market freaking collapses. And then what happens? The stock market collapses. That's what this chart is showing you, right? Like the Fed funds rate is a representation of bond market yields, right? So if this goes down and there's no demand for bonds because they're not offering any rate of return, then that means that the United States has to unload all of its assets, and they own a ton of assets because they need the capital that they would have otherwise received from individuals who are lending them money via the bond market. So hopefully that helps you understand why Jerome Powell needs to stay committed to interest rates, and it gives you another understanding of what the implication of this chart overlay is and why this is so important. The stock market collapses after interest rates fall because interest rates need to be above inflation. If they're not above inflation, there's no demand for bonds. And the United States, who is heavily invested in corporations that operate in the United States, will have to sell their equity in those companies because they're not getting any money from individuals lending to them via the bond market. But the opposing force to all of this are the politicians who say, no, you need to lower interest rates because you're harming the everyday person. This guy can't afford grocery bills because he can't afford any more credit card debt, right? So that's what the politicians are saying, and they are correct. And theoretically, if interest rates do come down, that does give the consumer more spending power, but ultimately it leads to a bond market collapse, which would lead to a stock market collapse. But here's where it gets really interesting. You have Jerome Powell testifying in front of Congress on Tuesday, and he's like, I'm going to raise rates. There's nothing that's going to stop me from raising rates. And I'm like, good. That's literally what you need to do. Thank God that you're committed and you're not, going to cave under this political pressure. But now the politicians have even more leverage to put pressure on Powell because they're like, dude, look at this, man. Banks are collapsing. Like, you're going to have to stimulate this, you're going to have to print money because you're going to have to make sure all the banks have all the money they need in case there's a bank run. So now it's like reality literally just gives the politicians that leverage that they need to increase that pressure on Powell. So we're at a very interesting point here because there is a Federal Reserve meeting March 22nd or something like that pretty soon. And right now the Federal Reserve has projected that they are going to raise rates 25 basis points. Here's the thing. With all this political pressure, the Fed might literally have to pivot now. They might actually have to freaking pivot. Not only is there a possibility that they have to pivot, they might literally need to start stimulating the economy to make sure that banks are flush. Now, we're very early in this process. It only literally started on Thursday, but think about it. Like, let's just look at the calendar at this point. Like, what's going on here in terms of like how much time do we have? Okay, so this next meeting, it's like either Wednesday or Tuesday. I think it's probably on the Tuesday. This week, March 13th through 17th, dude, Ides of March, dude. Beware the Ides of March, kid. This week is going to be nuts, dude. This is going to be everything because this week it's very possible that we see more bank run collapse type situations. This is a very contagious sort of situation that occurs because if one bank is like, we can't afford to pay out all of our clients, then other clients of other banks are being like, dude, I might have to take all my money out of the bank. And all the banks are under this pressure of like literally bank runs, right? So this is like one of the most contagious things that could possibly happen. Bank runs, highly, highly freaking contagious. And this week here, the Ides of March week is like, it's very possible that more bank runs would happen this week leading into Jerome Powell's meeting. And Jerome Powell's like, oh, all right, fine. You got me. I gotta lower rates. Okay, here we go. You win. I lose. I'm lowering rates. I got to print money to make sure all the banks have enough money for all the bank runs that are going to happen. And then what happens, kid? What happens if we have some kind of pivot situation like this on March 21st or March 22nd? Well, guess what? Guess what you have? You have one of these situations setting up, right? And let's just take a closer look at this, really get into the nitty-gritty of this whole dynamic here, because this is what happens when the Fed pivots or lowers, right? Look at this. I'm using 2007 into 2008 as the example. The first thing that happens when the Fed pivots is the market goes higher. That's the first thing that happens. But what's the second thing that happens? It literally crashes. Why does it crash? It's because of the bond market crashing. It's because there's no demand for bonds. The U.S. government isn't having any money from lenders that it has been relying on. And then the U.S. government has to unload its assets. And that obviously causes a cascade of selling. So, point being, first thing that happens is bullish, right? Think about it. If Jerome Powell comes out on March 21st and says, okay, yeah, I'm lowering rates, okay? Yep. Sorry, I failed. Have to lower rates. That everyone is going to be happy, right? Both Republicans and Democrats already want that. Everybody in the world will literally be rejoicing that that's going to happen because they're like, oh, look at all this free money. I can borrow all this margin to buy assets, and I'm going to need to buy assets because of inflation. Like, all of that will fuel a huge final euphoric blow-off spending top situation. That's what's going to happen, right? And everyone will think we're going to the moon all forever. It will be a false belief because really what's going on is the U.S. government will be in serious trouble because they don't have anybody lending money to them. That is the issue. That's what Jerome Powell is trying to protect against. He's trying to work interest rates up to the point where people want to lend money to the U.S. government because interest rates are higher than inflation. It's that simple. If they don't get higher than inflation, huge, massive financial crisis issues will emerge. So that's why if we see a pivot on March 21st, we know that the cycle is basically coming to an end, and the most frothy, profitable part of the cycle to the upside is just about to happen. And I think that's kind of likely. So let's just say, for argument's sake, that we're in this part of the interest rate cycle on, March 21st, right? Where instead of pivoting to lower rates, Jerome Powell just says, okay, I'm not raising rates anymore, right? Rates go flat. Look what happened when rates went flat. Look at this. 2008 right here. Look what happened when rates went flat. Market roars, kid. Roars. They started going flat in July 2006. Market roars all the way till October 2007. Over a year of market roaring, right? And this is because money's cheap, right? This means that everybody and their brother can literally borrow money to buy whatever they want. Real estate, equities, cryptos, everything. This would be, it's a blow off top situation. That's what this is. So if this is what we get to experience starting in March 2023, we experience the flattening of rates only to then lead to the falling of rates, then we can expect a very similar situation to 2008 occurring. And the thing is, theoretically, the best is yet to come for the bulls, right? And then if you're watching White Knuckle Reports and you know what happens next, you're going to make money on the long side, and you're going to make even more money on the downside, kid. Literally. So if we look at the VIX really quickly, there's already insane money to be made on the VIX. Like this move right here, this is, weekly chart, right? This is exactly what you would expect if banks are having issues getting their clients the money that they've been holding. Like, yeah, this is when the VIX spikes. You make a scary, scary amount of money if you are buying call options on the VIX in this situation. And I have been accumulating call options on the VIX for weeks. And the expirations on those call options are literally in like June and July and August. So like I'm well within the time frame to make a ton of money in the event that the VIX is about to do one of these things. You're talking about call options that move like multiple thousands of %. And if that's what we're headed into here, well then holy freaking crap. Like holy freaking crap, a lot of money is about to be made. But let's just kind of compare to the last time the VIX spiked. This is March 2020. This is the COVID spike. What ended up happening? Fed started printing money, right? So you have this big, fearful spike. You make an offensive amount of money on VIX calls when this thing spikes. But then what happens? The government stimulates, or rather the Federal Reserve stimulates. VIX comes down, stock market starts to roar, kid, right? I think it's possible that something like this is what's going to happen, because I'm saying, like, if we just look at the SPY really quickly on the weekly chart, actually, I think it's not unreasonable to expect that there could be another week of down selling. Ides of March week, that's the next candle that we're going to see. We see monstrous selling. This pivot breaks, right? So you have no longer a higher high, higher low situation. The higher low breaks, and then you have now a lower low. That would cause the VIX to spike ridiculously, but at the same time, the political pressures of easing fiscal policy will reach a peaking point, and that could cause Jerome Powell to pivot, which would ultimately send the stock market higher for a final euphoric blow off top. As we've talked about so many times on White Knuckle, this exact situation, final euphoric blow off top, and then what happens? Rates fall, market falls. It's because the bond market collapses. The government needs to cash out all of its liquidity and equity, and yep, you get a financial crisis. But you don't get the financial crisis until the market roars on the hopes of cheap money. And that's what politicians want. Both Republicans and Democrats advocating for the same thing, lower interest rates so we can spend more money. Literally history repeating itself here. So yeah, wow. All I got to say is beware the Ides of March, and it's about to get so good, dude. So good. This is the rodeo ride. You better know how to play both sides of the market, because you're going to need to if you want to get filthy freaking rich in 2023. And I literally think it's possible that 2023 might give us the opportunity to make the most amount of money that we'll make in years to come. Absolutely years to come. Because once this crash finishes, look, in 2008, the crash went from October 2007 all the way to March 2009. I mean, that's a long time, right? But then what happened? You get the bottom of the market. I think something like that is possible. And then what do? We get to ride this, because what are they going to do? When you get to the bottom, why is it the bottom? It's the bottom because that's when they literally just fill up cannons of money and shoot it straight into the market. And then what happens? You get one of these deals, right? Like, launch out of this freaking thing. So we're coming into probably some historic volatility, probably the biggest volatility we'll see in many, many years to come. And think about it. Look at 2021 into 2022. 2021 into 2022, monster volatility, dude. Huge volatility. And it started really back here in March 2020. But then, you had the water cannons of money, and you just got a rocket ship ride all the way to the moon. But then look at 2022, huge volatility. I think there's more volatility on the horizon, and volatility is good. That's what we need to make money. It doesn't matter which direction it is. It's just volatility. That's all that we need, kids. So, God, dude!